Good morning, Your Excellency, ladies and gentlemen. Obviously, the pull of coffee is keeping everybody next door. I'm sure they'll drift in shortly. Okay, so I'm somewhat different from your previous speakers, that I'm not entirely an expert on clearing and settlement systems. My background is very much in trading. For the first half of my career, I rose from a trainee dealer or trader to be head of global joint head of global trading for one of the major banks. That's Barclays International, or Barclays Capital as you would know it today. I then moved on from managing or trading liquidity into actually being head of global liquidity policy for the same bank, for Barclays Group, on a global basis. And it was during that time that I realized that it was indeed the payment and security settlement systems on a global basis that were consuming by far the vast majority of my liquidity. And following that, I got very, very interested in the technology behind, the systems behind security settlements and payment settlements, and eventually became somewhat of an expert in them. And eventually I was chairman of the UK's Rtgs system, Chaps Company, also deputy chair of the SWIFT organisation in the UK, on a number of infrastructure boards. So I came from a very different background. What I would like to emphasise this morning is that although I am talking about a regional Rtgs and cross-border settlement for this region, I'm not speaking on behalf of the GCC Rtgs team, but I will give you my insights on how we've got to where we are today, which includes the current development of that system, which is in production as I'm speaking. So that's the background. So what we're looking at is multi-currency or single currency. And of course it goes back many years in this region to 1981, when the GCC Charter was signed in May of that year, and the Unified Economic Agreement later that year in November 1981. So that was the emergence at that time of an aim to create the thought of establishing a common currency across the GCC, the members of the GCC at that time. Of course, since 1981 right up to the present time, there's been many conversations and presentations about the single currency for the GCC, and I've certainly spoken at a number of conferences in the region going back many years about that single currency. It is unlikely, in my opinion, to happen anytime soon. So what we're talking about when we're talking about linking Rtgses or having an Rtgs for the region is having a multi-currency, because we're still dealing at a time with 6 national currencies for the GCC members. So there we have the current position. It's national currencies. In each of the countries of the GCC, the nations of the GCC, they have fully established Rtgs systems, fully established security settlements, low-value payment systems. They have also their card transactions, so fully functioning clearing and settlement systems for each of those national currencies. And of course, this region has had rapid economic and trade growth throughout the region, intra-region and across the world. And there are a significant and growing number of financial transactions to support that business, both obviously in the sort of petrochemicals, gas industry, but increasingly in other technologies that are being developed in the region. So it's a very, very vibrant and expanding economic and trading area. So looking at the Gulf currencies and what could go into an Rtgs system that connects the GCC together, we look at the currencies that exist today, the 6 national currencies, and of course 5 of those, and for many, many years, they've had a fixed peg against the US dollar. I think the shortest of those 5 is probably 12 years or so, or 13 years since the last change in any of those fixed pegs. Of course, Kuwait has got a peg against an undisclosed basket of currencies, but again, that must be heavily influenced by the US dollar. So therefore, you can say that of the 5 currencies, and nearly the 6th currency, the actual movement, the central rate between those currencies, for 5 of them, it's a fixed central point, and for the 6, it doesn't fluctuate enormously during the day. So therefore, we start from a very good position where we don't have highly against each other, those 6 currencies, they're not highly fluctuating on a day-to-day, hour-to-hour, second-to-second movement, as other currencies do around the globe. They obviously move against the dollar, they move against other currencies, but against each other, by and large, they're fixed with a slight amount of movement against Kuwait. The significant majority of both volume and value of intra-GCC payments, electronic payments between the countries, the 6 countries, are in fact local to local. I did quite a big study going back 3 years ago now, speaking to the major commercial banks in the region, and I think there was a perception at that time that quite a significant amount, both certainly in value and in volume of transfers between each of the Gulf countries, was in fact in US dollars. That was a perception. In fact, on the investigation and speaking to many of the banks there, it became apparent by quite a large majority the payments between intra-GCC countries are dominated in local currency transfers. So it's a significant value, somewhat of a surprise. Obviously, the second largest currency used in the region is the US dollar. But as I say, local to local means obviously somebody remitting a payment from, say, Saudi Arabia to the Emirates. What would happen is that they would debit a Saudi Riyal account, because that's the account they had in their home territory. That would go through a correspondent banking network to be paid out in Emirati dirhams in the Emirates to a local currency account. So that's the designation of local to local. And of course, that's going through a correspondent banking network. And the same would be for US dollars. On further investigation, even though the US dollars was a not insignificant minority in both volume, well, certainly the value was higher than the volume of transfers. But upon further investigation, it became clear that a number of those US dollar transfers were only designated in US transfers out of habit rather than need, because it didn't start from a US dollar account and it didn't end at a US dollar account. So what would happen, it would go the same route. On my example, it would debit a Saudi Riyal account in Riyadh. It would be converted into US dollars. It would go through 1 or 2 correspondent banks in New York, depending on who the receiving bank was in the Emirates. As soon as the dollars arrived in the Emirates, it would be translated into Emirati dirhams. So there was really no need to use the US dollar in a number of transactions. Clearly, there are transactions where dollars are very important, certainly in the petrochemical and other industries where dollar-denominated accounts are quite common, and therefore dollars to dollars on intra-GCC transfers are not a problem. So the transfers are conducted today through the well-known commercial correspondent banking network. And in that, there is a variety of direct and indirect costs. The direct costs that you know up front of making that payment, but the indirect costs, I guess, it may include a foreign exchange transaction cost. If you're translating, as you're translating from one currency to another, there may be costs along the line, depending on the number of correspondent banks it goes through. And these could be debited at the start of the transaction, at the end of the transaction, to the remitter, to the receiver, a variety of different methodologies of both those direct and indirect costs. and certainly a variable time to complete the end-to-end transfer from the remitting institution or the remitting customer, not just the bank, the remitting customer, from his account to the receiving customer's account at the other end of the transaction. Some of those times could take anything, well, several days. And in some cases, if they were going through other third currencies, not local currencies, because of delays in verifications going through 2 or 3 different correspondents, it could take weeks as checks had to go backwards and forwards. So we look at the global context and cooperation for RTGSs, primarily used as for high-value payments, but not exclusively. But we tend to think as Rtgs as a high-value payment system, and certainly all the high values go through it where they can. So some of the global the context behind all of this already been mentioned by Wasim in his legal presentation this morning, because obviously a principle number 1 of the PFMIs. It is the Committee of Payments and Market Infrastructures these days, the CPMI, which has been around for a while, which took over from the CPSS. But they, of course, have a number of principles which, by far, the majority of central banks around the world and regulators refer to these principles as the guiding rules and frameworks around payment systems, payment and settlement systems. These are not all of them, but there's 20-odd principles, but they are bunched into or collected into a number of headlines, which are the general organisation of a system, including the legal and governance, which was talked about this morning, credit and liquidity risk management, I guess, which is where I come from primarily, the settlement including finality, that very key point that was discussed again this morning, and the central bank money, to me, being the gold standard, and certainly emphasised as the gold standard. It is entirely possible to have an Rtgs system in commercial, well, I don't refer to commercial bank money because in my definition, I'm not a lawyer, but there is no such thing as commercial bank money. Jean-Michel might argue with me. But to my mind, there's no thing as commercial bank money. There's commercial bank credit, because that's all they do. It's just book entries. There's only one real source of money, which is central bank money. So there is Rtgs systems, and certainly a number of the cross-border Rtgs systems that have the dollar underlying it, but not exclusively the dollar. They do use commercial settlement agents, so it's not central bank money settlement. You have default management, general business and operational risk management, accessibility, which is very important to these systems increasingly, where you have non-banks accessing some of these systems, the efficiency and transparency, again, of knowing what's going on. And that's very key for regulators, that transparency, both for the users and the regulators of these systems. And plus you have the responsibilities in these PFMIs for the central banks, market regulators and other authorities. But there are other regulatory challenges, and certainly Jean-Michel, it was one of his main points yesterday when he was talking about the shrinkages or the demise of the correspondent banking world. Now, why is that? If you go back 15, 20 years to many SWIFT conferences many of us have been to, the correspondent bankers that were there, and they were the mainstay of it because it was supposed to be where they made all their money. And that was their linkages, how they got their introductions to other banks. They set up accounts for each other, and therefore they hope to get other trade out of all that network. But of course they charge an awful lot for that. But following, obviously, the situation in 2007, 8 and 9, the global banking crisis, there was a number of regulatory resources which have impacted significantly the commercial correspondent banking market, in my opinion. And it's around the liquidity coverage, and the regulations themselves, the ones that I'm most concerned about, and these are not the exclusive ones, but that I think have had the biggest impact on the correspondent banking world, is the liquidity coverage ratio and liquidity monitoring tools that came out in January 2013 from the BIS. This covers the amount of liquidity, and in the LCR, that's basically the short-term liquidity from 1 day to 30 days they're looking at there, and how banks monitor that. It's key importance, because if you're operating as a bank, you need to know that you are liquid in order to make your payments, but a little bit more on that shortly. Monitoring tools, this is the key importance for the correspondent banking network, is that the monitoring tools for intraday liquidity management, which was issued in April of 2013, and this is looking at the lifeblood, the liquidity of payment systems, security settlement systems, and this is what makes them work. If you, just the analogy would be a car engine, think of a payment system as a car engine. If you don't put any oil in the car, very quickly it will seize up. If you don't put any liquidity into a payment system, very quickly it will seize up as well. For completeness of all of these that are affecting, in my opinion, the correspondent banking model, or the commercial correspondent banking model, is the net stable funding ratio. That's a long-term structural liquidity, that's from 30 days out to infinity. Doesn't impact directly on payment systems, it is the liquidity coverage ratio, but more importantly the intraday liquidity stuff that is concerning the correspondent bankers, but I should mention the net stable funding ratio for completeness. So this is what is impacting the cost of providing extra capital and extra liquidity to support their businesses, and the cost of that has increased tremendously because of the volumes, even at very low interest rates. The cost of holding that absolute top quality collateral that most of them have to hold these days, and the need for, and the requirement by central banks to improve the quality of the collateral all the time. In this region it's primarily it's government securities, so that's at the top of the list. That's increasing the costs. And that's why the number of participants in correspondent banking is going down tremendously. I know in another role that I've got as a senior independent director of a small financial institution that we were looking to get a second banking arrangement for another bank for obvious reasons. You always want at least, if you're not a direct member of a clearing system, you want a settlement member and you want a backup just in case something goes wrong. To get a second bank account for a fully recognised and profitable financial institution, it has taken us nearly 2 years to get a second bank to bankers. And it's not a big deal, so you can imagine that if you extrapolate that into high value and volume payments, then it's hard to find correspondent bankers these days. Liquidity risk management is a key importance to payments. I've always said that you can't move liquidity without a payment, and you can't move a payment without liquidity. Simple phrase, but these two in my mind are inextricably linked together. Most of the people that speak about payments and security settlements come from either an IT background and operational, they're experts in operations. Very rarely do you find in the same room people like me that come from a liquidity management background and have got into payments. Increasingly that needs to happen, that needs to be understood, that absolute direct linkage between the two is absolutely crucial, and therefore going forward as volumes and values rise and as people need more and more secure systems with, to prevent blockages and all that sort of stuff and gridlock within these systems, it is important that you consider together liquidity management and operational management of a payment, a clearing and settlement system or a security settlement system. Quite simply, liquidity risk is manifested when an organisation is unable to meet its payment obligations when they fall due and to replace funds when they are withdrawn. In particular, its obligation to repay depositors and fulfil commitments to lend. I didn't have to read that because I think I provided that to the Bank of England several years ago, and it's pretty much used, certainly in the UK. But where do all these obligations fall due? Well, of course, they fall due every second of every minute of every hour of every day in payment and security settlement systems. Certainly in the security settlement systems when I'm talking about real-time or DVP, real-time DVP. But of course, the practical time horizons for liquidity. short, medium and long term, that's what most liquidity managers would say, but in my terms, short term is intraday, medium term is overnight, long term is a week, because quite frankly, after a week, in a liquidity crisis, you're bust or somebody else owns your organisation. It's a fact of life. And a reflection of that was a situation in the UK, going back to the banking crisis, when we all know that the UK government had to take on a shareholding in a number of institutions, the biggest being the Royal Bank of Scotland, at the time the biggest financial institution in the world, and its problems were purely a liquidity problem, because over the weekend they had to tell the Bank of England that on the Monday morning they didn't have anywhere near the liquidity to meet their payments in the CHAP system and other payment systems around the place that they were obligated to meet. And it's that simple fact that they couldn't operate they couldn't open in the payment systems that the Bank of England had to turn around to the government, and the government put in the rescue to enable RBS to meet its obligations as they fell due. So this is not some prosaic statement about liquidity. It is absolutely the lifeblood of the global financial system, and the payment systems, security settlement systems, are the heart of all of that. So the pressures on traditional correspondent banking and why the GCC Rtgs is, in my opinion, crucially important. Post-2008-9, before the banking crisis, significantly less competitive participants. The cost of participating has risen considerably. Sorry, post-2008, as I said, there's significantly less participants, so the cost has gone up. Increased capital requirements, as I said, increased term liquidity requirements to back up those liquidity requirements, the LCR and the NSFR, and significantly increased intraday liquidity demands on those major correspondent banks. In fact, many of the target's been different. I mean, Target in itself has been very well constructed in the sense that it has so many direct members, huge number of direct members. If you take the UK system, the CHAP system, then it's the inverse pyramid, or was for many, many years, where really at the bottom of it, you turn the pyramid upside down. At the bottom of it was a very small number, and there's basically four major clearing banks, as we would call them, settlement banks, at the bottom of it, supporting the entire sterling market. And that was all the overseas banks, that was all the domestic banks and everything, and all the volume going through them. And there was a huge risk in that. And therefore, that had to be addressed. And now, increasingly, certainly in the UK, the drive for direct participants has been around for a number of years now, and is increasing as they roll out their papers on the progress and the renewal of Rtgs in the UK. But at the same time that correspondent banking has increased, technology, both hardware and software, have improved significantly, and certainly continues to do. So what you're able to do is fantastic compared to what you were able to do. Basic costs of many of the stuff has fallen sharply, but balanced against that, the cost of compliance has risen significantly. So there is less competition and higher costs in the correspondent banking network. So just looking at those two things to justify why Rtgs is a solution across the GCC, and a multi-currency one. On the correspondent banking, you can quite easily see under those two columns there that commercial bank credit, I'm not using money, versus central bank money. Under the control of the central bank, under the issuance of the central bank, they're the only ones who can increase or decrease supply. Commercial banks, of course, can increase and decrease credit, the gearing on their balance sheets, but you are taking a risk if your account is with them. That's a risk that many people are quite happy to take. That's your choice, but it is commercial bank credit at the end of the day, and hopefully you hope that your commercial bank remains open overnight. I'm not suggesting there's going to be a second banking crisis by any stretch of the imagination, but certainly one has to consider commercial bank credit against central bank money when you're settling high-value payments. Variable delivery times in correspondent banking, as discussed, against immediate or near immediate in an Rtgs system. Correspondent banking, finality and irrevocability. Well, I think the answer to that one is I'll see you in court, I think, rather than achieving through a full-blown Rtgs system a finality and irrevocability. There is segregated liquidity in the correspondent banking network depending on who you're using. You may be using a number of correspondents in the same currency. You'll certainly be using different correspondents in different currencies, and each of those will require a segregated pot of liquidity to manage. Most of that unable to actually transfer value from one system to another, from one currency to another, from one country to another. In a GCC Rtgs, you'd have a single liquidity pot, so both your domestic liquidity, and that's where you generate your payments to the other GCC countries and would receive payments inbound from other GCC currencies into your home currency, would all be reflected in one single pot of liquidity managed in one place, both domestic and cross-border for the GCC. There are limited liquidity management tools within the correspondent banking network. You're reliant upon the information that one gets from your correspondent bank or banks, and there are numerous of them. That's why in most banks their reconciliation systems are quite big and quite expensive. But within a single system you have enhanced liquidity management tools at the centre, which enable you to, as long as you're following the rules of that system domestically, in your domestic Rtgs, it allows much richer liquidity management to be carried out and to be overseen as well. So there's an early warning signals for the central banks as well. Of course, in correspondent banking there are a variety of direct and indirect costs, including the FX rate. Whilst, of course, when you have a single system, there's certainly the possibility of much simplified cost structures and FX rates. That goes without saying. Not going into too many details about that, because clearly the final rules and regulations on what the GCC Rtgs will be for the participants is yet to be finally agreed, but it gives that certain possibility of simplified cost structures and FX rates. And of course there are two fairly simple model designs, also there are many more when you're looking at these. The traditional decentralised model, one that Target 1 looked at and others have looked at, is where there are direct links, bilateral links between the participants within a structure, commonly known as the spaghetti model, for obvious reasons. I suppose its one advantage is if one leg goes down, then you're only affecting that one leg. But clearly managing those connections is incredibly difficult, and arguably moving to an integrated model where you have the Rtgs is feeding into a central Rtgs system to create an end-to-end full-blown, fully functioning Rtgs engine, which is the integrated model. And that, of course, is crucial to allow that immediacy of payment, that near real-time transfer of funds from one currency to another with an automatic exchange rate in the middle of it, and to be delivered with finality and irrevocability. And of course the Rtgs systems allow, as been said this morning, it allows monetary policy to be delivered by the central banks through their Rtgs system, through their money system, through their operations, that they add or subtract money from the system, and obviously, crucial point, it adds to the financial stability of a country that you have a highly regulated, highly secure for financial stability reasons. So the business benefits, and I do apologise if I rush through this a little bit quickly, but I'm conscious of time, and also that you really do want to speak and ask questions to the panel following this. That the business benefits to the GCC for a fully integrated Rtgs system which will be a multiple, is a local-to-local system. So that is one currency to another. So that's a multi-currency system. It also would have the benefit in the design to add any other currencies that you wish. So if anybody else joined the GCC and they qualified for the system, you could add that currency. Also, you could carry the GCC single currency if it ever came about. And also you could carry any other currency, the US dollar or the euro or any other currency that you decided to carry. The difference is that at this moment in time, the GCC currencies would be in central bank money, central bank settlement agent. If it was the US dollar, the model around the world is where there's US dollar settlements in an Rtgs system, that's done by a commercial bank settlement agent. The reason for that is that usually no central bank, certainly to date, the Federal Reserve System doesn't allow another central bank to clear its currency. And that will be the same around it. So the business benefits significantly increased efficiency of cross-border GCC payments, and there is a significant market to address. Supporting all GCC currencies and other countries and currencies if they come along to be members, full members of the GCC. Support the GCC single currency to strengthen the markets that the system supports, and that's through financial stability, increased financial stability, and the ability for monetary policy. Fosters financial stability within the region, as I said, immediate settlement with finality and irrevocability, settlement in central bank money, not commercial bank credit, and crucially meets the growing business and regulatory drivers in the region and supports the increased business inter-region. So that's a quick run through, but why the GCC Rtgs is alive. It is now in the build stage. It's gone through the design stage. It's now in the build stage. There will be more information coming out as that progresses. So it's a very exciting time, and I think if you look around the world, and as Jean-Michel and others have said, that there is an increased demand for inter-regional, intra-country Rtgs's. Now, how you link them up, there's arguments. When all see, people give me the example of the mainland China and Hong Kong having an Rtgs system. Well, that's not. It's two separate Rtgs systems linked together. It's not a full-blown end-to-end Rtgs system. What has been designed for this region, in my opinion, for the size, both in value and volumes, it can take, is a world first in a multi-currency, high value and volume Rtgs system, which is expandable to other countries and other currencies. Thank you very much indeed. Any questions, I guess, can come up in the question and answer session following this. Thank you very much.